Thank you for joining us and addressing our audience on a Saturday. I'll start with your introduction for the benefit of audience. Ms. Sohini Adnani joined SBI Mutual Fund as Head of Research in 2007 and was subsequently promoted as Portfolio Manager in 2010. Prior to joining SBI Mutual Fund, she was a Senior Research Analyst at ING Investment Management. She has over 11 years of experience in research on the sell side. Her previous assignments were with leading broking outfits such as ASK Raymond James, LKP Shares and Securities, Advani Share Brokers, and KR Choksey Shares and Securities. She's a commerce graduate from Mumbai University and a chartered accountant holder from ICAI. She's currently managing more than 59,000 crores across two of the largest schemes, SBI Blue Chip and SBI Magnum Midcap. Overall, she has 27 years of experience in the asset management industry. Thank you, ma'am, for joining in the call.
My pleasure. Hello, everyone.
So, ma'am, we will first start with a very basic question that everyone has in their mind. We have seen a phenomenal last year market rally last year, starting from late March. And markets have, particularly in mid and small caps, they have generated more than 50% returns. The index has delivered more than 50% return over the last 1 year. And on the large cap also, they have generated healthy absolute returns. So how do you see this market rally? And what's your overall take on the valuations that are there in the current scenario?
Yeah, sure. I think that is a question everyone has, and it keeps surprising everyone in terms of the kind of rally which is sustained, throughout. See, one thing which I would want to say, and this is what we've seen in the previous cycles as well, is that, whenever you have an earnings upgrade cycle, which continues or sustains for a period of time, that is where you see the market, the stock, the overall market re-rating and the stocks re-rating significantly, and especially on the mid-cap side. So whenever you have a period of, the overall corporate sector earnings being flat to negative, that is a time when, even the mid-cap stocks kind of struggle, they don't deliver any return. So we had a period where for 3 years, you almost had a flat return on the mid-cap side between, I think, 13 to 17 or I think 14 to 17, something on that side. So I think whenever, there is an improvement in the earnings cycle, generally the mid-cap stocks deliver much higher growth vis-a-vis the large-cap stocks. It also leads to operating leverage and a margin improvement for them. So the earnings growth is even much higher. And generally in this period, you also see the primary market pick up big time. And there is a supply of stocks and capital raise which happens, and with a good growth outlook. So we see this phases in the market where the stocks do see a significant re-rating when the earning upgrade cycle kind of pans out, and which is what we've seen it. Whether we had an understanding well in advance of this happening, I think it was not so clear, because again, the extent of recovery post-COVID and, to what extent we will recover and where, then we had a lot of challenges in terms of supply side constraints and what happened to the whole supply chain. Then the commodity, commodities saw big inflation, and it kind of impacted the growth and the margin both. So I think we are coming out of that whole period of challenges. One due to COVID, when there was a shutdown of businesses, etc. Then you had a supply chain constraints across. Then you had a commodity, and because of which the commodity price inflation was very high. And after all those challenges, when everything kind of reversed, the delta that you see on the growth, especially on a lower base, has been very significant, and hence the market has also given a thumbs up and a re-rating. Now, whether the valuations have been above average, the answer is yes, for the overall market also and for the mid-cap segment especially, because if you overall also see market cap to GDP, it's pretty high. It's like an all-time high for India, vis-a-vis its previous kind of peaks that we've seen. So overall, yes, the valuations are high. Whether we sustain here, I think it's a question mark of what happens to the earnings upgrade cycle and whether the earnings can keep delivering the surprise.
Right.
You will always see a cycle there as well. But are we going to see a small dip and then again recover, or a big dip is a big question mark. I'm saying more from the earnings side, and the market will kind of follow it for sure. So I think, if we have a stable government at the center, and the probability for which has increased post the state election results, at least you will see continuation of policies and whatever on the economic front, and the corporates will have a more confidence in terms of taking up new projects. Basically, what we've seen is that last 10 years or 15 years, the capex cycle was a very muted one, and we've just seen the pickup started to happen only in the last 2-3 years, which I believe that it will see a further momentum. Real estate also as a sector has been a big sector, and that has also seen a pickup post consolidation, only almost 10 years of consolidation. So these sectors can see a pickup, and then the overall growth momentum can continue. But I think we'll have to still wait and watch. Another bigger factor is the cost of funds. Basically, with the high interest rates and high inflation scenario, I think the cost of leverage has gone up significantly. So any businesses which are dependent upon high leverage, they may see a challenges we will see in the coming year. So I think it is still something, a year which we should look forward to. Whether the market will consolidate or correct, I think some correction would be a healthy if at all it happens. I think it depends a lot on the flow of funds that we may see as it comes. So
Right. And so far we have seen good earnings growth, and a lot of the rally has been supported by strong earnings. There has been a fundamental support that has been given to the markets. Correct. And ma'am, you touched upon the cost of funds. We have seen indication from the Fed earlier rate cuts. So how are you looking at the interest rate scenario, and whether the cost of funds we would be entering into an interest rate scenario where we would experience some reducing cost of funds, and what's your take on the overall interest rate scenario?
So interest rates are higher vis-a-vis what we saw in the last 5 years, for certainly. But they're not higher if you see, last one decade or something. So I think we've seen this level of interest rates in the past, and that's not been something, a big constraint to the growth per se. But obviously, all businesses do not sustain in a higher interest rate environment. So the businesses which require less capital and less leverage, they do much better. My sense on the rate outlook is that we are not going to see a steep decline in rates in the next year for sure, because we are still in the inflationary environment, and the growth itself leads to some bit of an inflation. So what I feel is that the interest rate should be in a pretty narrow band for the next 12 months as well. Not move much. I think the upward trajectory looks like that we've come to, quite close to the peak per se, and I don't see the rates going up very significantly unless the inflation goes out of control, which I think how RBI has managed, it doesn't look like to be a case. And globally also, since they're calling a peak in the interest rate cycle, we don't see the rates moving up for sure. But at the same time, we are not again going to see either in the US like a 0 or a 1% kind of an interest rate scenario. And neither in India, you're going to see like a 4-5% interest rate. So I think we're still going to be 6.5 to 7.5% kind of a band at most, I would say. So I think they would more like they will stay. And globally, I think there is still a lot of challenge on growth, because up till now, many of this debt that people have is a long-term debt, and it keeps coming for a repricing. And as on the servicing cost for the same debt kind of goes up, it affects the overall consumption cycle, and which is what we should see much more in the developed market, because it is a very heavy leverage market overall. In India, while the retail loan growth has been very, very robust in the last few years, but still, if you look at it, the overall leverage for the retail consumers has been pretty less. So we shouldn't get affected too much on the consumption growth. But globally, it should lead to some effect on the consumption growth and hence the overall growth as well. So for us, the impact would be that the businesses which are quite dependent upon the exports market, they or the part of the business which is linked to the exports market, that should see some growth challenge, and hence your overall growth outlook will also get moderated if you are a mix of a domestic plus exports or largely exports.
Right. And ma'am, you manage one of the largest mid-cap fund. For the benefit of audience, we would just like you to clarify what are mid-caps. What is the range of companies that classify over there? Range of the size of the companies. And since you talk about exports, and what is the sectoral distribution in mid-cap index, and what is their exposure in domestic? Because we have a belief that a lot of mid and small caps are domestic focused, consumption focused. What is the sectoral distribution in the mid-cap index or in the mid-cap companies?
Sure. So first of all, for the benefit of larger audience, how now SEBI has kind of classified stocks into large cap, mid cap, small cap, etc. And top 100 stocks by market cap are large cap. The next 150 stocks are mid cap, and anything below the 250 stocks are small cap. How the asset allocation, which is prescribed by SEBI for mid cap fund, is that at any point of time, minimum 65% has to be into mid-cap stocks, and the rest 35% could be either a large cap or a small cap, or even a cash is included as a part of this 35%. Again, the mid-cap stock, it's not a very static universe. Like every 6 months, based on the average market cap of last 6 months, the SEBI comes out with a list that these are the mid-cap stocks for the next 6 months. So I think they keep that list constant for 6 months, 2 quarters basically, and then it keeps changing. And then we have to adjust our portfolio based on that. So I think that is where it is. I think on the higher side, right now we are somewhere at around market cap level of about 60,000 crore, the highest mid cap classification, somewhere very roughly, and at the lower level it is somewhere I think 20,000 crores or so. So I think broadly that is a range of market cap that we are playing. So these are the companies which are not very small. They are sizable enough in terms of they've already had a business presence for quite some years, and they've grown to such a size. And these thresholds have kept going up. So if you had looked 5 years back, the threshold looked much lesser, almost half of where we were in terms of market cap. So I think we keep moving up, and I think it's a good thing to have it based on the market cap range in terms of rank of stocks. only thing I would have wished is that the universe shouldn't have been just 150 stocks, that becomes a too smaller universe. As far as the 2/3 of the portfolio is concerned, the rest 1/3 could be anything else that we can buy there. In terms of sectoral classification, I don't right now have an exact percentages in with me, but it is quite diversified across sectors. And you have both companies which are domestic as well as export oriented into that. Many companies are mixed in terms of businesses where they have about 60 to 70% of the revenues coming from domestic market, 1/3 coming from the exports market. To give some example, if you look at financials are largely the domestic market, and financials would have about I think close to, because the definition keeps changing every 6 months. I don't have it right away. We can send it to you. But it should have about 20% or so, somewhere between 18 to 20% weight in financials, and which would be largely domestic. Then you would have about pharma exposure, which will be again 10-12% or so, which will be a mix of both domestic as well as exports, because many companies have a huge exposure or an emerging market exposure. You also have industrial exposure. Again, within industrial companies, you have the presence in the domestic market as well as exports market, which will be about 15-16% or even slightly larger exposure there. So I think and then IT would be again another 10-12% or slightly more, which will be largely export driven sector. So you also have real estate. So I think it's a fairly diversified basket that you have, and it'll have stocks across both the exports and the domestic market. But still, the weight of domestic story in the mid cap bucket would be higher vis-a-vis what you have in the large cap bucket, I would say.
Right. And ma'am, you were talking about the size of the companies, 20 to 60,000 crores. About 1.5 years back, I was looking at that number. So that was around 15 to 50,000 crores.
Yes.
Now we have seen the growth in 1 year itself. And ma'am, so it's a very diversified basket in the index.
So just to also mention how we have in the our mid cap portfolio, what is a sectoral allocation that we have, because I thought that would be of interest.
That was the follow-up question, ma'am, that was coming.
Yeah, so I think we have a consumer discretionary sector, which is the largest sector, where we have about 30 to 32% kind of an exposure. Now, how it is split is that half of that is auto and auto ancillaries, about 15-16%. And the rest is the non-auto part of the consumer discretionary. And when it comes to non-auto, this is split across various different kind of businesses, which is a pure discretionary business, like the stocks like a Page Industries or a Jubilant Foodworks or a Sheela Foam kind of a stock. We also have their hotel stocks, like an Indian Hotel kind of a stock. We also have some of the textile names there, like Gokuldas and KPR, etc. So I think the range of consumer discretionary, while it looks like a big sector, one sector like almost 1/3 of the portfolio, it ranges across sectors, but still within that whole basket, auto anchs, and largely in the mid cap bucket, it is more of auto anchs, which is about 15-16% kind of an exposure. Within auto anchs also, we've kind of quite diversified across, say a two-wheeler or a personal vehicles or a CV cycle kind of a different portfolio. So kind of pretty diversified exposure within the auto bucket as well. The next big sector would be financials, where we would have about 15% or so of exposure. Within that, we have an exposure to one CRISIL, which is a rating agency, is about 3.5% of so. We also have two NBFCs like Chola and Sundaram Finance, which are more CV heavy, those kind of a thing. And we have some of the smaller exposures to Mahindra Finance and also some of the banks like a Federal Bank, etc. So I think it's a mixed portfolio there as well. Then I think industrials is another sector which is heavy in the portfolio, and where we have exposure to various stocks, whether it is towards power like a Thermax or to the pure industrials like bearing companies, which is SKF, Schaeffler, etc., which have an exposure both to the auto and the industrial segment overall. So I think we and Cummins, which is again power driven. So it is a power, non-power across we have. We also have an exposure to real estate sector, which is about 6-7% of the portfolio, where we have names like Oberoi Realty, Godrej Property, Phoenix Mills. I think largely Bombay driven, market driven stocks, where you have a better visibility in terms of what's happening on ground. So Godrej is now much more all pan-India kind of a company. So I think these are the larger sectors where we have exposure, and then we have some exposure to utilities like Torrent Power, etc. Which is doing good on the power generation distribution business, etc. And also some of the other stocks there. Cement is another sector where we would have like 6-7% of the portfolio on the cement side.
Right. Thank you so much, ma'am. Ma'am, another question as wealth managers, we get on the investment horizon in equities, and we always recommend to go to have the very long-term investment horizon. Right. But when you are picking a particular stock in the portfolio, what kind of horizon that you take in your mind for a particular stock?
Sure.
And what would be the typical churn rate of the portfolio?
Sure. So I think when we look at stocks, I mean, this answer will be partly answered by how we pick our stocks, and to just give some color. I think when we look for our portfolio has always been more tilted to growth, because we believe that India is a growth market, and there is enough opportunity for the businesses who execute well for them to grow the businesses. So we've looked more at the growth opportunities, and then we look at fairly long-term growth opportunities. So how we look at it is that if the company is of X size today, whether it can become 4-5X or even much larger than its current size, whether the sector or the business that they are, whether that offers that kind of an opportunity to become quite big. Second thing is how good is the management in terms of delivering on these kind of an opportunity, whether they have grown in past, whether they are able to scale up the business, invest into business, broad base the management structure, and what kind of a capital allocation will be required for that to achieve that kind of a growth. So generally, our investment horizon, since we are looking that the company should become 4-5X, is very long. So unless once we buy the stocks, we want to do like a buy and hold kind of a portfolio. Unless we believe that structurally there is a problem, either we have selected a wrong stock or something has gone wrong on the management side, and we don't want to be in the business, we continue to own the businesses in the portfolio. And we have stocks which we've been owning for almost 10 years also, and we still continue to be positive and will still own in the portfolio. We may tweak our holding size in terms of how much exposure we want to have into that stock based on how stronger rally we see in the stock, and whether we want to prune exposure in the for some time and again scale it up when the valuations become reasonable. We do that. It's not that at any price we continue to keep holding the stock. Generally, what we do is that when we believe that the next 3 years growth is also priced in, we would like to book some profits, irrespective of how long a growth opportunity that we are seeing it. But we are also conscious that we don't sell these stocks too early. in the overall growth momentum that the company is. So you try to balance it in between slightly if the stock rally much in advance, whether you continue to still own from a long-term perspective because you believe in the long-term growth. I think we try to adjust our weights on those stocks rather than completely exiting the stories. So the churn is pretty less in our mid-cap portfolio. But some part of it is also driven by, the SEBI definition of stocks because, typically we buy the stocks and they rally well and they become large cap, and either we have to sell them off or at least cut our weights over there because it's a limited weight that we can own in the portfolio. So I think that is a big thing, but we are happy to do that because what happens is that, we've already made a very good money when the stocks become that large that they become large cap. Then we always look for the opportunities from the lower market cap to add stocks again in the portfolio, which again can present that kind of a potential. So I think largely that is what we keep doing in the portfolio.
Right. Thank you so much, ma'am. Next question is on the amount of flows that we are seeing in the current markets. We saw phenomenal FIIs flows last year, but the DIIs flows were almost equal, almost 169,000 crores of flows in DIIs. And we have seen a strong SIP book developing. So I think last November it was roughly 17,000 crores. So is it providing a strong cushion to the markets? How are you looking at the flows that are coming from the domestic players and the SIP books?
Sure. So I think the SIP books clearly they give much more stability to the overall flows. It also shows the maturity of the markets where investor want to come from a long-term perspective and they're not looking at a very short-term trading kind of a mindset, which is a good thing to happen. But I believe that the market has now got much more depth in terms of the number of players which are there in the market. So I think, while the domestic flows were very strong, we saw a lot of selling by the FIIs and all that. Generally in the mid-cap sector, the exposure by FIIs is much lesser. So we've not seen a correction much in the mid-cap segment, and kind of the flows have also driven the valuation up kind of. But I think that poses some kind of a challenge. I believe that, the flows sustain when the 3-year and 5-year returns look very decent, in the mid-cap segment, if you see returns, CAGR returns of more than 15-16%, then it is very attractive for the people to put money. And today, if we see 3-year returns, they look much beyond like a 25% also. So they look very attractive, and even for the 5-year or even a longer term returns are looking very fantastic. But my sense is that if I've looked through the cycle, I think when the long-term returns look 15-16%, then the market is in a good shape. If the returns exceed, then we may again have a period of some consolidation or a correction which may come in between. So I think today, as we see, the valuation seem to be fairly running ahead of where the growth opportunities are. So unless you keep seeing the earning expansion happening, we may have some period of consolidation or a correction in the mid-cap segment, which I believe would be quite healthy. We don't see a big potential for a very big correction unless you see some big accident on the global market side, and which has an impact on our markets as well. Again, the SIP book gives now much more stability vis-a-vis the past cycles. So I think that is a comfort. But we it's not long before that. If you during the COVID period, we saw substantial correction on the mid cap segment. So I think we should never say that this will not happen. whatever. So these periods do keep coming, but again, the bounce back is strong enough if the fundamentals don't change in a meaningful manner.
Right. Thank you so much, ma'am. Now we have a few questions from the audience. And it's a very popular question that people are looking at this year general elections. So how do you look at this kind of event, and how do you look at this event risk in the market?
Yeah. So I think generally going into the election, the overall the economic momentum kind of picks up because the economic activity is good. The government spending also happens. They kind of try to drive the economic performance also up. So there is a bit of a euphoric momentum before we go into an election. And post election, we kind of see a bit of a calm down in that mood, even if you see the stability of the government, etc. I think again that there is some cooling off effect post election, which happens at least for 2-3 quarters before growth again picks up. So I think we will see that kind of a phase in the economy, that till fourth quarter, or even largely till fourth quarter, we will see a good momentum and a bit of a cooling down in the first half of FY26, and then again we may see a pickup if we have a stable government at the center, and given the state election outcome, there seems to be a high likelihood that we will have that. But you can never say with a certainty that that is what would happen. But again, when we construct a portfolio, our general attitude is that not to build a portfolio based on a very short-term momentum in what will happen during the election period or something like that. The idea is that you own businesses which do good over a long-term period. They deliver good growth over a long-term period, and they do it very efficiently with less leverage and a less capital requirement, so that they're not too much affected by the capital market slowdown, even if that happens in between. So in general, we make a portfolio to be very, very robust, that it delivers better in any kind of an environment. But obviously, if there is a stable political environment, it definitely it gives a boost to the overall corporate confidence levels and the investment in the sector in the country. So it would be good if that happens, but we may see a period of cooling off in the first half of FY25, quite possible.
Sure, ma'am. And the next question is on the earning trend. Any analyst estimates that we have on the earnings growth in the mid-cap space? So estimates for the earnings growth for mid-caps.
I don't have it ready-made with me, but I think what generally when we see the markets pricing in, it is definitely a double-digit growth, or more than that, slightly more than that. Could be 15-16% growth is what is priced in. I'm saying earnings growth. The revenue growth may vary a bit from sector to sector depending upon how the commodity inflation plays out during that phase.
Right.
And this could be again driven more by the top line growth in most cases, because of generally in the higher inflationary environment, because your nominal GDP growth is also higher vis-a-vis the real GDP growth. It translates into a better top line growth, but we'll have to see how the bottom line growth is. And I think that should be a bigger driver in terms of overall valuations, I would say.
Right now, right. The last question that we have on the AUM side. So, particularly in mid-cap space, does a smaller AUM gives you the benefit, or larger AUM gives you the benefit, or is there any sweet spot where we feel it's beneficial in the mid-cap space to manage the fund?
Well, a fund manager always would prefer a smaller size AUM because that gives you a much more flexibility in terms of what you can do in the portfolio. However, I think more than the absolute size, you will have to watch it vis-a-vis how the overall market cap thresholds also go up. So I think, 5 years back, I would have thought that a 5 or a 7,000 crore mid-cap fund is a very large fund to manage.
Right.
And today we are already 16,000 crores, and we are fine with managing that size of fund. So I think with every market cap threshold, these thresholds will kind of change. I think the bigger thing is apart from the AUM, how within what time frame the inflows come. So when inflows come through the SIP route, I think they are very gradual inflows, and that is much better way to manage inflows vis-a-vis a very a very sizable inflows coming in a very short period of time. That creates a challenge in terms of deploying the fund in these kind of a market. So I think as far as there are regular inflows in the fund, it's not a big challenge, because incrementally then I'm just deploying another 5-7% of the AUM. So I think that is more comfortable vis-a-vis in a short period receiving a very significant inflows. So I think the pattern of inflows will also matter.
Right.
But yes, the size matters at some point of time, not only from the mid-cap fund size, but like we being a largest AMC, like we have other funds which also invest into mid-cap portfolios. So
Right.
we'll have large and mid-cap, we'll have a flexi-cap or a multi-cap fund, or even a small-cap fund, which would also invest into the mid-cap universe. And sometimes we are capped by our ability to invest because we reach almost 9-10% of the company's capital. And then incrementally to deploy the, into the same stocks is not possible because as a fund house, we would have reached our limit. So what it does is that it kind of increases the tail in the portfolio to some extent because there is an upper threshold.
Right.
So that is one constraint that we have to keep in mind.
Right. As you rightly said, the size of the companies have also become bigger. So then
Yes.
the AUM threshold was that also
Yes.
goes higher.
Right.
Right. Man, it's been a wonderful session. Thank you so much for taking all our questions. I very much like the explanations on the market side, on your fund investment philosophy, on how you're building the portfolios. And thank you so much for taking out time on a Saturday afternoon and addressing us and our audience.
Thank you so much. My pleasure to speak to all of you. Have a great weekend, all of you. Thank you.
Same to you. Thank you. Thank you so much.